Thank you to come back after lunch, and thank you for the previous discussions that made the complexity of water risk very tangible. And I remember, if again permit me, I remember a question that has appeared several times during the morning regarding our role as a central bank, even though or considering that we are not making public policy, and this is out of our mandate. But in any case, I remember a dialogue between President Lagarde and Professor Rockström some months ago in the European Central Bank. And at the end of the conversation, the dialogue, the President Lagarde asked to the Professor Rockström, okay, how do you see the role of central banks talking about nature, environmental degradation, climate, etc.? And the answer was very rich, but one of the most important points is that, first, I think that the central bank has the authority and has the resources to understood perfectly what are the needs, what are the solutions in order to evaluate the impact and assessment on all this kind of risk. And second, you are the most powerful voice to introduce a topic in a country, in a debate, in a conference, whatever you think. And I think that this is the reason why the Banco de España, the European Central Bank, and many other central banks are here, because we really think that we need to understand what is the impact of all this kind of risk, and also use our voice in the following months to explain to the society, to citizens, that this is an important risk, that we need to take care of that. No? And this is the reason also why in this afternoon we are starting with financial authorities here. And I hand over the stage to Marie Gabet, that she will be moderate the session. So, Marie, thank you.
Thanks a lot, Juan Carlos. Can you hear me correctly? Okay, perfect. Do shout if I become inaudible at some point. So just to complete this brief introduction, so I'm really happy to be your moderator for this session. I'm Marie Gabet. I'm a member of the NGFS Secretariat, coordinating the activities of the NGFS Task Force Nature. So you heard our co-chair, Elias, talk a bit about what we do this morning. So alongside my distinguished panelists, we have the difficult task of keeping you awake after the amazing lunch that we had from Banco de España. So we'll do our best. We have a variety of points of view that is going to be really interesting, and we try and stick to the time that we are allotted. But I mean, this kind of meetings is also great because we can have bilateral discussions afterwards. So just to complement on what Juan Carlos was saying this morning, we heard about how water risks are material at the macro financial level. We heard about how they manifest from the real economy, how water shocks then propagate through international supply chains and trade networks, and then ultimately that has material consequences for credit quality, asset prices, financial stability. So during this first afternoon session, we'll focus on the implication of water degradation for financial supervisors. Just as mentioned by Elias this morning, I mean, we are not strictly waking up to the existence of water risks. They've been increasing recently over the recent years, also because as a combination of the increasing climate and nature-related risks. And as also was hinted by Juan Carlos, the work that we're doing at the NGFS based on climate or nature is identifying water, as one of the most material environmental risks for financial actors. So supervisors, they face growing pressure to clarify expectations, to strengthen prudential frameworks, and to embed water into supervisory dialogue. The thing is that, as Mathilde was telling us, this sometimes requires knowledge that usually ministries of environment possess. So supervisors do have to dig deeper on how this risk materialize and how they can draft these expectations. So what we're going to do right now is to study with our panelists how supervisory authorities are beginning to assess water-related impacts on credit, on markets, and operational risks, and how these insights can inform the evolution of supervisory practice across jurisdiction at very different starting points. So we'll also consider how supervisory action interacts with the wider ecosystem of standards, disclosure, data infrastructure that supervision depends on. So we do have a good and dense agenda, and luckily we have just the right panel for that. So I'm joined here by Irene Heemskerk, who's the head of the Climate Change Center at the European Central Bank. We also have with us Alberto Casillas Cuevas, who is a senior advisor to the general director at the Banco de España, but also co-chair of the NGFS workstream on supervision. Then we have Elena Viñas-Festas, who's the chair of the EU Platform on Sustainable Finance, commissioner of the Spanish Financial Market Authority, and also co-chair of the Task Force on Net Zero Policy. We are then joined by Hanne van Voorten, who's the head of supervisory practices and operations at the IAIS, and by Najwa Mouhaouri, who's the head of the Climate Finance Regulation Department at the Bank of Morocco. And before the Q&A, we are lucky enough to have Maud Abdelli, who's the lead of WWF's Greening Financial Regulation Initiative, and who will act as a discussant with our speakers before we hand it out to you, the audience. So maybe just to set the scene a bit further on how water shocks, water degradation is relevant for financial supervisors, I'll hand over to Irene, who will give us a brief keynote on water-related risk and on the work of the Climate Change Center on water.
Thank you. I'm going to stand. Is there a clicker here for the... Yes. Because I'm going to share some slides with you. Good afternoon, everyone. It's a real pleasure to be here with you today. And thanks so much for hosting us here and looking forward to discussion. What I really liked in the introduction of Juan Carlos and also you, Marie, emphasizing the relevancy for central banks. And this morning we heard a lot of references to the role of central banks, the signaling effect, that it is macro-critical. Well, I think we all have to agree on that, the macro-criticality, and also the financial risk it causes. I'll share a few slides on how our approach is, just to share a bit, I think, also the context that we're operating as a central banks, as maybe not all of you are so familiar with this. So I start with nature, because we're talking about water, but I think we have to start from the big picture first. And on this, you see the conceptual framework that was developed by the NGFS, and one of the key lead people behind this conceptual framework is with us here in the room, and there are many contributors as well. So how do we look at how nature degrades and how does it affect our economy? Just a really basic slide, but I think it's good to have this in mind because it helps us to understand the whole process further. You have nature degradation, so there's a decline in bees. How, in the end, ends this at risk of balance sheet of banks, right? Or water scarcity, how does that affect credit, strategic risk, credit risk, market risk? We always define the two sources, the physical risk, the transition risk coming from regulation or diverse changes in preferences. This affects companies, micro effects on businesses and households, also regional or sectoral effects, and also macroeconomic effects on outputs and inflation. That's the economic risk. And when banks are invested in those companies or any financial institution, financial actor in the world, this leads to financial risk. And what I think is also important to highlight on this slide, because there are a lot of arrows pointing that way, right, on how nature degradation can help on balance sheet. But also want to put the feedback loops that are in it, right? Because also banks and all financial institutions, everyone in the society, also finances activities that might lead to nature degradation. So having that in mind, and also keeping in mind the two effects, the two ways on how we interact with nature as a society, as an economy, as financial institutions, this is the basis how I see it. At ECB, we looked into, in 2023, we did a study on the dependency of how dependent is the Euro area economy on nature services like fresh water, fresh air, stable ground. We found that around 75% of all 4.2 million companies are dependent on at least one ecosystem service. And there were also around that percentage of loans of banks invested in companies that are so highly dependent on nature. Dependency doesn't necessarily say something about risk, because if it's there, if the resources are there, it's not necessarily causing a risk. So what we did further on, we teamed up with the team of Nicola Ranger, with LSE, with Oxford, and we looked deeper into the risk of nature. And here I also have to share that this is quite, pioneering work. When we did this dependency analysis, we could go on firm level. But if you go to risk, we could only look at it from a more sectoral economic output level. So the level of data on risk is not there yet. But I think this research really gives a good already sense of where the risk could emerge. So we did this, and the outcome, when we looked at the euro area economy, the outcome is that water-related risk caused the highest risk on sectoral economic output in the EU. Groundwater, surface water, flood and storm protection. You also see water quality, the filtration. So this is something to keep in mind. And when we saw this, this was for us a reason to look a bit deeper also into the water-related risk. So we did a study and we assessed a 1 in 100-year drought. Is it feasible? Will this emerge? Well, if we look at the trends, you see that their droughts are becoming more severe and more frequent. But think about 1 in 100-year droughts. It can put 24% of euro area economic output at risk due to surface water scarcity. And if you look at the map of Europe, there's probably something else you notice. Some parts are a bit darker red, some parts are a bit more orange. So you also see that where the risk emerges also differs in regions and sectors. So this is, I think, gives us also a good indication on where we have to look deeper into. So this is the economic output that was put at risk. We also looked into the corresponding share of loans at risk. So 19% of bank loans given to non-financial corporations are invested in companies that are at risk. And we also looked at it's not only the direct effect, but also the supply chain effect. So around half of our overall nature-related risk are related to global supply chain. Here is a slide that we looked a bit more into the sectoral impact. The share of drought-affected areas has increased remarkably in Europe, and agriculture is the most affected in terms of relative sector losses. And that's the one on the left, the bar on the left. And that the left bar with is the dependency. The bit darker color is when there's a 1 in 100-year drought, and then there's if you have a 1 in 25-year drought. So you see, of course, the impact is there, but it's not only agriculture, it's also mining, water supply, manufacturing, construction, accommodation, food services. So to look at it from this perspective, okay, where will the risk emerge, in which sectors, gives us insights again to look deeper into the risks. We also looked a bit deeper into the water-related risk for banks. So the increasing water scarcity and water pollution could become material sources of credit risk, potentially amplifying systemic vulnerabilities in the euro area. And the highest concentration of loans risk come from water scarcity in the real estate sector. And this is not so weird if you consider that of all the bank loans, 26% is in real estate. So there's a lot of the balance sheets on banks that is in real estate. So that means that the risks are amplified there more than in other sectors. And water quality is more relevant, of course, for manufacturing, mining, and food services. But this, I think, is a bit of an indication on also where the banks see the risk emerging. This is a slide showing good practices of banks. And I really like the remark made this morning by Salome from National Central Bank of Georgia. Like, it's not just telling banks, manage climate and nature-related risk, manage water risk. I think we all have to learn from each other. And that's why we at the ECB published our good practices guide. So in 2020, we already issued our expectations. What do we expect banks to, how they manage climate and nature-related risk? Then a few years later, we also published our good practices, and just recently, I think 2 weeks ago, we published an update of our good practices guide, because we can look into the kitchen of all banks, and seeing how they manage it. So we went there and we collected, okay, this is a new innovative way how you can actually manage it. And we collected all those practices in this guide, around 160 plus pages, so take your time to read it, but I think it will give you a good insight of what you can do, and there also help banks to progress on the topic. But let me talk you a little bit to like what do we see? Like we really see that banks are improving on identifying and mapping exposures. So for example, they analyze their portfolio on vulnerabilities across water sectors, and even more advanced banks look also into the geolocation of their assets, postal codes or other areas. On risk drivers, we see that they're really translating droughts and floods into economic variables and linking them to firm-level performance. On the credit risk modeling, they're integrating water risk into credit risk modeling, so they're incorporating water-related risk into credit risk, so probability of default or loan given default. On the running, like the scenarios, of course, what is so important with water-related risk, I think we all see this, that it's becoming much more severe, but we don't know how the future will look like. So running these scenarios and looking forward on how things could emerge and where the risk will sit, we see banks running forward-looking scenarios covering chronic water stress or acute events, so already incorporated in their forward-looking stress testing. And lastly, we also see banks developing metrics and monitoring tools. So for example, indicators to measure exposure to water stress or other things, but there we see, okay, they monitor it, but we do see still room for improvement to tie actions or define metrics. Okay, when is this indicator turning red and we actually need to do something? And what action can we actually put into those consequences? So you see, like, there is a lot of awareness, and we see this really emerging. Banks have made great progress since 2020 when we issued our supervisory expectations. Now all banks have a materiality assessment in place for climate and nature-related risk. Climate risk has been more advanced, but we need to look into the full picture, look into also nature, and water is certainly one of the topics that we see as an emerging risk that deserves higher attention. And I'm really glad to be here today with this panel, and I hope I set the scene a little bit to have to listen and learn from our other panelists, and also get your questions and discuss with you. Thank you so much.
Many thanks for this great stage setting, Irene. I think that now it's quite clear, if it wasn't clear earlier, that we do need to take water into account into our financial supervisory activities. And it's also great to learn about what is being done at the European level on that. So maybe we'll do a bit more of a focus on supervisory practice at country level, and I'll turn to Alberto. And so Banco de España is among the supervisors that are actively integrated water-related risk into supervisory work, right? So from your vantage points, how is water showing up in the credit, in the market, in the operational risk picture? And also, I mean, Irene told us that some banks were quite advanced, for example, when it came to improving their mapping of exposures. But do you see that in Spain? And how do you navigate what might exist as a messier reality, that some banks are ahead of supervisors on this, and sometimes some banks are behind?
Okay. First of all, thank you for inviting me. It's a pleasure to be here and to share our views about these water risks and their impacts. Let me begin with a fundamental message. As Irene mentioned before, water risks is not a new or standalone category of risks. From a supervisory perspective, it has always been embedded within broader climate and environmental risks, and it's materialized through traditional financial risk channel, namely credit, market, and operational risks. Let me say that they are increasingly material driven of financial risks. Obviously, their intensity is, let me say, is expected to rise across future scenarios. So as our challenge as supervisors is to translate that reality into practical supervisory approaches. So having said that, and from this starting point, water risks manifest differently across the three main financial risk categories. Credit risk is by far the main transmission channel. This is structural. It is where data availability is greatest, where quantitative tools are more developed, and where materiality assessment tend to assign the highest weight to climate and environmental risks. To give you a quantitative illustration, ECB analysis estimate a negative impact of 77 basis points on CET1 under amplified flood scenario transmitted entirely through credit risks. The magnitude of exposure is also significant, not marginal. In Spain, around 20% of bank lending is linked to activities sensitive to water ecosystem degradation, and at a European level, more than 1.3 trillion of euros of corporate credit, over a third of the euro area total, is exposed to sector facing high water stress, often concentrated in regions and industries with intense hydrological pressure. Recent Spanish cases illustrate how these risks translate into credit. The October 2024 Dana event did not lead to a significant deterioration in asset quality, but this was due to public support measures, such as eco-financing, moratoria, and the insurance compensation consortium. This showed that hydrological shocks can translate into credit losses rapidly and with a strong geographical concentration, particularly affecting a smaller and more localized institution. And the second example or case in Spain is the drought in Catalonia in early 2024. It's a different type of risk, obviously, but it's chronic, slow-moving, yet disrupted, affecting agriculture, tourism, and urban services. There is also a key structural factor we must emphasize: the insurance gap. In Europe, only about 35 to 45% of natural catastrophe losses are insured, and this gap is widening, particularly for floods and droughts in southern Europe. As frequency and severity increase, insurers are withdrawing from high-risk areas or changing affordable premium. For banks, this has direct prudential implication. Collateral that was historically protected might no longer be insured, and property valuation in high-risk areas may still underestimate exposure. If insurance protection disappears, the residual risk is effectively absorbed by the banks. Regarding market risks incorporate water risks through three main mechanisms. First, supply shocks, for example, when droughts reduce agricultural output or energy generation. Second, valuation effects, including penalties in equity prices and credit spreads for water-intensive sectors. And third, stranded asset risks linked to tightening water regulation or concession regimes. However, the observed impact so far remains limited and cautious, largely due to data constraints. This fact has been confirmed by the ECB 2022 climate stress test. In the third, operational risks is an increasingly important channel, and it comes through multiple vectors. Direct physical damage from floods and extreme events, business disruption and continuity challenges, depends on water resources, for instance, for data center cooling, and importantly, legal and reputational risks. In supervisory practices, quantification remains limited. In the 2022 stress test, operational and reputational risks were assessed qualitatively through questionnaires rather than quantitative tools. At the same time, we observed that institutions are progressively granularizing climate and nature-related events in their operational risk framework. And final, legal and reputational risks are also gaining traction. Environmental events can trigger litigation, question about due diligence and liability exposure, not only based on what institutions are doing, but also on how they communicate it. And there is also the growing risk of greenwashing claims. Regarding your second question, let me turn to coordination. I would say that the most powerful driver of alignment is not just regulation itself, but the supervisory dialogue and the evidence generated through continuous monitoring, particularly via SREP. And as you know, the SREP in 2022 introduced the climate and environmental risks, and now is fully integrated as 2024. I stop here.
Okay, thanks a lot, Alberto. So you mentioned, and rightly so, the issue of insurance gap. This makes me want to turn to Hannah next to ask you a bit more about the specific point of view of insurers. So the insurance sector, it sits at a distinctive position on water risk, right? Because of underwriting exposure to floods and droughts and holding investments exposed to the same shocks. So what is the IIS seeing across its membership and how supervisors are approaching water, and what does the insurance vintage reveal that big supervision might miss?
Oh, that last one is a tricky one.
I'm sorry.
I'll start with can you hear me okay? Yeah. I'll start with the first part of your question, but maybe first a bit of a disclaimer, because at the IIS, maybe those who don't know the acronym, it's the International Association for Insurance Supervisors. Those of you who are not working in insurance, we often say it's the Basel Committee for Insurers. We're also based in Basel in the same building. And disclaimer is, we don't have a water work stream, so, but that doesn't mean that we don't look at water. So when I was invited for this panel, and I also I looked at all the materials and the work that we are doing, I wanted to take you along the journey of the journey that the IIS has taken on climate risk, on natural catastrophe, on protection gaps, and how water is kind of really flowing through that journey, so to say, in all of our activities. So, as we are insurance supervisors, we take a very deliberate, a very structured, and a very risk-based approach. So we started off with one big question, which was, okay, why does, well, you could say water or climate-related risk or extreme weather events, why do they actually matter for us as insurance supervisors? Why is it relevant to our mandate? So that was the first question we asked ourselves. And the answer is not so much does it matter, and then also why does it matter? So the answer was a clear yes. And this is one of the things where around the table with the insurance supervisory community, there's really a clear understanding, clear consensus, which well, there's not always consensus on everything, but there's a clear consensus that this is really at the core of our mandate. So that I'm talking about the prudential mandate around our insurance companies aware of the risks that they are facing, both, as you say, on the investment side, but also on how they underwrite and how they cover the risks, and are they managing it? On the consumer protection side, are they offering products that actually offer value for consumers? Are they offering products that are available, that are affordable as well? Are they transparent about what they actually don't cover? And then also for maybe the more macro angle, which Alberto already pointed towards, is, and I'll take it a little bit higher abstraction level, is that the question of can insurance actually still perform its role in society and its role in the financial system, its role as risk managers, basically, its role as promoting societal resilience. And there you are seeing, with increasing climate-related risk, with increasing floods, sea level rise, which I don't think it's been mentioned already today, but sea level rise also of course there, drought and other elements, we're seeing increasing risks there. And the big question is, can insurance companies and can the insurance sector as a whole still perform the functions that they are expected to perform? So all in all, this is a first part of our journey was, okay, we agreed this is important for us. It doesn't really matter if you're a conduct supervisor or a prudential supervisor, if you're like in an integrated central bank plus insurance supervisory authority, it matters for you and you have to look at these risks. So then the second step that we did was to look at, okay, but what are then precisely the risks? So dig a little bit deeper. So that means collecting data, doing some analysis, and publishing on that as well. So one example is last year we published, I think it was in November or December, we published a report which was trying to address the question of what are the potential financial stability risks of these increasing weather-related events, under the assumption and under the knowledge that insurance will only become less available. So protection gaps, as we are seeing already, are only going to increase. And we took a bit of an evidence-based case study approach. So we had several case studies. One of them was flooding in Pakistan. Another one was a major drought as well in Malawi. And what you could see there, a couple of lessons as well around, especially on drought, but is that the difficulty to really measure it. So the difficulty to have forward-looking measurements, so that makes it difficult for insurance companies to actually price the risk and to offer the products. You can see also a lack of awareness amongst consumers, amongst those who actually have to think about, should I even buy insurance, yes or no? And also, of course, again, the lack of data as well. So what you see there, this is not just related to these water-related risks, but I think, for instance, for sea level rise, which I do want to mention again as well, is something that inherently is already not insurable. So that is only kind of increasing the additional risks that there are around what type of risk may be covered in the future by insurance. And of course, if it's not covered by insurance, the risk doesn't go away. So it's still somewhere out there. So it's either hitting consumers, small businesses, ultimately then the banking sector, or governments will have to maybe step in with again, various implications. So all in all, I think we all agreed that, yes, there are risks. You need to analyze them. We also saw in that report that the risks are quite different from country to country, because for one, it's flooding, so it's too much water, not enough water. What was the other one? Not clean enough water, right? Yes. So even clean water is important for insurance. I won't really go into that today, but insurance companies also have liability insurance, so then they cover maybe big corporates who, I know there could be something in their factory and then there's water pollution, then actually that's also covered by insurance, but I won't go into that maybe in details. Third point was, so firstly, is it relevant for us? Yes. Do we analyze it? Yes. The third point is, okay, what do we actually do about it? I won't go into detail now because I think we have more details on that later as well, so I'll save that for maybe the second round. What can banks learn? Well, I think we can both learn from each other, to be really honest. If I look at the analysis that you've done, for instance, at the banking side, it's in many cases also more sophisticated than what we have done. But for me, the main point that we can learn from each other, I would put it like that, is sharing. So actually speaking to one another, working together. Often what you see is that there has been a climate scenario analysis related to flooding or etc. on the impact on the banking sector. Then I asked the author of that analysis, like, have you looked at insurance coverage? No, it was very difficult to get the data. Or we look at the impact of extreme weather events on inflation or monetary policy. Also there, no, it's very difficult in the modeling to also have assumptions around insurance or the lack of insurance. So maybe us, finding each other more and trying to share data and doing joint analyses, I would say that's maybe something where we can both benefit from each other.
That's an amazing answer, and I said that's a call for actions for central banks and supervisors across the room to see that insurers and banks in general speak to each other a bit more, because I think that's one of the blind spots that we sometimes have in general. So that's great that you underline it. Thank you, Hanne. So maybe, hopefully, if we do that, we'll manage to set really clear expectations from supervisors. But Helena, I'm now turning to you. Supervisors can clarify expectations, but those expectations, they only translate into practice when the wider regulatory architecture, so taxonomies, disclosures, data assurance, is moving in the same direction, right? So from your vantage points, chairing the EU platform, where is that architecture now Is it ready to support supervisory action on water?
Thank you so much, Maria, and good afternoon to everyone. It's a real pleasure to be with all of you today. But actually, what Marie has just asked me, it's slightly challenging because in a way, you've asked me to not only try to explain you in less than 5 minutes, but it's the architecture of, the regulatory architecture of sustainable finance, but also to provide a sort of a first assessment and all of that through the lenses of water. So please bear with me. It's not simple. And last but not least, on top of it, after lunch. So I'll try to do my best. The Sustainable Finance Framework, the regulatory framework, is basically, by and large, a transparency disclosure framework. So that means that supervisors were not going to judge or assess the actual reporting. You're just looking at whether or not companies and the different financial market participants disclose what they are supposed to disclose and in the way that the regulation says. So that is really important because we've seen in the market some real misunderstandings sometimes, for example, when it comes to financial products, where they took, what it is, and apologies for all the terminology, Article 8 and Article 9 funds, so 2 categories, as categories when actually they only say if you register it as Article 8, then you need to disclose that. If you register as Article 8, you need to disclose that. And people thought that that might have been a guarantee of actually the performance of the impact of those funds, which is not. And that needs to be really highlighted. So that said, basically has 2 foundations. Yes, on one hand, the European Sustainability Reporting Standards, the ESRS, and on the other hand, the taxonomy. The ESRS work at entity level, and it asks companies to disclose a series of indicators, if they are material, because the vast majority, particularly now with the revision that has just taken place, not totally finalized, but almost, basically most of the indicators, particularly in water, are only to be disclosed if the company believes that it is material from a double materiality perspective. On the other hand, the taxonomy operates at activity level. The taxonomy does, though, and is the only tool that actually sets up performance levels, and it tells you, which performance levels you need to achieve in order to be considered sustainable. And this is really important because both tools are very complementary. And these are the main tools that then financial market participants and financial institutions have to then sort of construct their green loans or green bonds, or let's talk about blue loans and blue products, or the financial products. On one hand, using ideally the taxonomy, because then they could aspire to get the EU Green Bond standard, because the regulation actually sets that golden standard, which is the EU Green Bond standard, so you get your stamp. On the other hand, again, financial market participants and financial institutions can use the disclosures from the ESRS and the bit of the taxonomy. I haven't talked yet, but the taxonomy has, most of you would know, what we call substantial contribution. This is how you actually contribute to achieve the water objectives, but also the do no significant harm criteria. So making sure that no matter in what you invest, you are not going to harm the water, you're not going to make things worse, basically speaking. So you can use that to de-risk your portfolios, whether we're talking about credit portfolios or investment portfolios. So really, really summarize in a nutshell, that's what the regulation out there is. So what's the state of play? That's the question. Well, when it comes to the ESRS, I'm sure, or the state of entity level data reporting, CDP is much better placed than I. But as you may know, not all countries have transposed the directive. It has been revised, so we're going to leave that to aside. I am just going to make 2 comments. I really wonder, and this is a real question mark, with this new approach, top-down to double materiality, where the company decides whether or not it's material, how many companies are actually going to disclose water, related indicators, taking into account already that the scope of application in terms of those companies that need to report has already shrinked in an 85 to 93%, and that the water indicators in a 70%. Maybe we improve the quality because as there are few indicators now and few companies, maybe all of them report, that's yet to be seen. But the other thing I wanted to comment is that what it is clear is the taxonomy becomes more important because all the companies under CSRD need to disclose the taxonomy. And I ask yourselves, ask you, if a company conducts an activity that is included in the taxonomy, doesn't that mean that it's material for the company? I would say, it would be very difficult for companies that have activities included in the taxonomy to say they're not material, water is not material for them, and therefore I ignore the water E3, which is the water list of disclosure. In terms of the actual performance on the taxonomy, we just hit the 1 billion. So the taxonomy between 2021 and 2025, there's 1,900 companies that report on the taxonomy have invested more than 1 billion euros in align with the taxonomy, that is in align with the climate objectives. But 98% of that, it's on climate mitigation. And one of the things that we realize is not only, and we need to be very clear, is not only that climate has captured most attention, but also we need to be fair because the reality is that the taxonomy is incredibly biased towards climate mitigation because it has 110 plus activities in climate and only 15 in water. Yeah. Also, we realize that a lot of companies do not disclose for all the environmental objectives that we might have, and this is something that we're looking into. Problems on reporting against other environmental objectives other than mitigation. But that said, the good news, and this for me are really good news, is understanding that 1 billion has included the do no significant harm criteria for water. So it means that we might not be investing much on water-related, new solutions or activities, but at least we're not harming, and what is invested in line is not harming. That's one. The other thing I wanted to very quickly share with you is that when it comes to bonds, I think we are on the 5 billion of blue bonds, which is relatively decent if we take into account that, again, we have real problems of capturing the real investments in water. Like with funds, we have the same problem, which is the majority of bonds and the majority of financial products are not labeled exclusively as blue, but they are green, and within that, they have a part on water. And that, we still haven't really properly monitored what is that part of investments. Having said that, when you look at the green bonds globally, 75% is on mitigation in 3 sectors, so real estate, energy, and transport. So you start getting a little bit of the picture. When it comes to, and I finish with this, with portfolios, funds, we're talking about 39 billion, I think, globally. But the good news is that half of that is Europeans, so it's Europe made, but it's roughly 2% of all the funds. So we're still really struggling, basically, to cut a long story short, to make specific investments in water that tend to come more with the rest of the environmental objectives.
That's very interesting, and I hope that it's food for everybody in this room. It's great to hear about exactly how investments are at the moment. So great picture of that. Thank you, Helena. So maybe to end this first round about our state of play in terms of financial supervision of water, I'll do a bit, go away from the European focus, and I'll ask Najwa to tell us a bit about what's happening in Morocco. So Morocco is dealing with real and intensifying water stress, and its central bank is developing a supervisory response in that context. So could you tell us a bit about what it looks like to build supervisory capacity on water in a jurisdiction where the risk is already materializing, right? And what should supervisors in more water-abundant markets learn from your experience?
Thank you, Mari. I would like first to thank the Bank of Spain for the great hospitality and the OECD, NGFS, and CDP for organizing alongside the Bank of Spain this session. And thanks for having me and for having the Central Bank of Morocco. Morocco has been mentioned a few times earlier, and one can guess how much of water stress we are actually experiencing. Morocco is one of the most water-stressed countries in the MENA region, and according to the studies of the World Bank, we have 33% of our GDP which is at risk from 2 or more natural hazards. This is due to our geographical position and high rainfall variability, so we are really very prone to climate and nature hazards. Forward-looking studies as part of the Climate and Development Report I have mentioned also this morning show that Morocco may experience climate-related water scarcity before the end of the current decade, despite some commendable government policies. So at the level of, so critically African countries, and why I'm talking about African countries, because that was perfectly mentioned this morning, the cross-border exposures do matter. Critically African countries could lose up more of their GDP because of nature-related risks, and the economic impact would affect negatively and heavily the financial sector, more than in advanced countries, because we do have weaker structures of financial markets that have insufficiently deep financial markets, insurance markets that are still developing, and the credits are most of the time concentrated in banking portfolios, which exacerbate the impact on the financial sector. In Morocco, for example, the agricultural sector has a high economic relevance, and the financial losses from nature-related risks, so climate-related risks, could directly spill over to key economic activities that Moroccan banks are financing, especially due to output-input linkages. So as a central bank and banking supervisor, and as part of our risk-based supervision, we do assess risks to banks' activities. While in the past the financial losses weren't identified as being maybe climate or nature related, the simple mapping between the non-performing loans in the agricultural sector and the past dry events reveals how much our banking portfolios are actually vulnerable to nature-related risks. With this in mind, we have actually started addressing nature and environment-related risks back in 2016 by first convening a financial sector platform. Coordination and strategy were key starting points, especially in an emerging market context. It's essential to provide the signal to the market, to the wider society, to have the buy-in, to implement also the institutional coordination, the public-private coordination process. Building capacities were actually the next step, and as it was also mentioned by our colleague from Georgia, it's important to build the capacities and the skills maybe before defining the supervisory expectations. So in 2021, we have defined our supervisory expectations to banks on how they should be managing both climate and environmental-related risks through risk management, strategy and governance, scenario analysis, and disclosures. And as we moved over time into more technical guidance, it was actually easier for us to address climate-related risks. So we've had a climate-first approach, very gradualistic, but our global regulatory framework is flexible enough and could accommodate additional supervisory expectations for nature. So the NGFS guide for supervisor was a useful source of guidance for us in defining our expectations. We have then run our risk assessment to assess the extent to which Moroccan banks are exposed to dry and flood events, but also to transition risks. and the estimates are an unsurprising reminder of the vulnerability of banking portfolios in Morocco to physical risks. So after we've performed this risk assessment, now we're trying to move into a full supervisory process for environment-related risks, and by promoting more revealing disclosures, because data was the mostly common actually challenge. And when we've performed also run our stress testing, we figured out how difficult it could be to access and translate maybe climate data into finance-related impacts or economic impacts. So we're trying to promote more revealing disclosures. Today we are requiring from bank ISSB 2 standard is implemented and in place in Morocco, and starting from next year we should have ISSB disclosures from Moroccan banks. It's a mandatory requirement. We've been quite more ambitious than the Basel Committee because it was published before. It's released its principles, and we're also trying to build the risk risk data aggregation capabilities of banks. We have introduced prudential reporting for banks on large borrower exposures to climate-related risks. This would help to make sure that the internal reporting practices of banks could produce timely information and monitor material environmental-related risks and include some of the mostly relevant nature-related risks. So today we are also, as we move forward, we're trying to build our supervisory capacity and try to avoid disconnected approaches and have an integrated supervisory process for both climate and nature-related risks. And we're trying to utilize the international expertise and the tools that are being actually developed by the NGFS. And we do think that the methodologies and tools that are already in place are hopefully helpful to help us also cover and extend our supervisory process to cover nature-related risks. We have already covered drought and flood events as part of the climate vulnerabilities, but it is also within the nature broader scope. But we are striving to also cover all the nature-related risks, especially as we have a greater exposure, and we cannot wait to take any immediate actions. So we do believe that the current practices, methodologies, and tools that are in place would help us in this way. And we do need also to assess the extent to which the Moroccan banks are exposed to wider nature-related risks. It's important to determine the historical nature events' impact on GDP. That would help to better calibrate maybe also forward-looking scenarios building on the work the NGFS is engaging on. And the greater the exposures will be, the more serious and severe the responses, prudential responses will be from the central bank and from Morocco. We may also consider introducing some technical reporting guidelines on nature-related risks, especially as the Moroccan taxonomy is currently being developed. It should be completed by next year, the end of this year. So we could seize the opportunity of this taxonomy to have more prudential focused instruments and more revealing disclosures covering also nature-related risks. That would be the necessary prerequisite for our nature-related risks assessment exercises. But when we think that the compliance with our regulation, recently issued regulatory guidances on both disclosures, prudential reporting, and the wider risk management framework for both environmental and climate-related risks would help to improve the capabilities of banks that are actively implementing and have either implemented or are actively implementing data infrastructures and improving their analytical tools. So it would be easier for them maybe to account for nature-related risks. For the sake of time and to conclude, I would say that in a fast-moving space, quite a number of resources and materials are released every day. And we are trying to keep up the pace while being mindful of the limited expertise and capabilities of Moroccan banks that are now working actively on climate-related risks. I'll stop here, thank you.
Thanks a lot, Najwa. It's great to really hear about the detailed process that took you through supervision of climate risk to nature risk now. And well, I'm personally very happy that you mentioned nature and that you're trying to do as much as you can to identify nature risks. And I think it's really important to stress how capacity building is key to build knowledge on this and to act on these kind of risks. So it's great that we mention it quite often in this roundtable meeting. It's also, I guess, one of the main missions of the NGFS, so I really resonate with what you said. And that allows me to do a bit of a commercial break between the two sessions of this, the two rounds of this panel session, and mention the fact that the NGFS recently released a note on the supervision of nature-related risks. That could be also interesting for capacity building purposes, and that has a lot also to do with what was shared here. So maybe, for the sake of time, we can do a condensed version of our second round that would be on lessons learned and next steps. So I might ask all of you to give me the abstract of what your answer would have been. So maybe I'll turn to Irene first. Based on what was said during the first round of this panel and from the ECB's perspective, and the work of the Climate Change Center, where does the supervisory frontier on water need to move next? And what is the ECB's ask of peers around this table to get there?
Thanks a lot. Well, first of all, we need to stay the course, and we need to go into the weeds, because we can talk about and we can easily agree on water-related risk or nature-related risk or climate-related risk is important, but how do we actually see it? Well, I showed on the slide that banks are making progress. What we have in the books, I'll mention two things. One is we'll do deep dives on physical risk. Climate, nature, and water is obvious one of them in the coming, starting soon and in the coming years to go. Learning there more on how banks actually manage risk, look into the kitchen and see the practices again and see how they can move forward. Second part I would like to highlight, we had a very good meeting, our first meeting of this group in person yesterday here, within the so-called Euro system of central banks. So that means all central banks in the EU. We got a group together on water risk. And it was so motivating to discuss the different lessons that we can learn from each other and being in the room with the colleagues. And many are in the room here today as well, from Malta, Cyprus, Germany, Netherlands, France, Spain. And I can mention more, in total 12 national central banks and the ECB working together, co-chairing this together with Banque de France, with Stefan Dees. What are the macroeconomic impacts? What are the financial stability risks? And what is the data that we need for that? So that's something that we'll be working on. At some point, comes to the phase of maturity, and then we'll publish it. And I hope that is useful for everyone. And that brings me to your last point on, what can we do with peers? What are asked? And I think it was already mentioned by Johanna, like, make sure that we share all this kind of information and we make sure that we progress together. I always say it a bit like we need to talk to strangers because you often talk to your neighbors or the people or the central bankers around you because you speak the same language, but really talking to people who work with water on the field, learn from them, where are the risks emerging, learning from how the banks see the risk coming, and also trying to really, in the end, preserve the water that we have. So 2 things in the books.
That's great, thank you. Maybe I'll change a bit the focus and turn to Helena for a quick question, an abstract of an abstract. So if the surrounding architecture has gaps, whose job is it to close them? What can the EU platform and similar bodies actually deliver, let's say in the next 2 years, that would ensure that risks are properly integrated by financial actors in order for supervisors to be better supported?
Thank you. But let me start by rectifying something I said before. I was talking about 1 billion, that we reached the 1 billion, the taxonomy. And you probably were thinking, why is she making such a fuss for 1 billion? I actually meant 1 trillion. We reached 1 trillion. So very important, yeah? We reached that historical level of 1 trillion. So now you see why it's such an event, yeah? So talking about that, the first thing we need is to improve the reporting, the corporate reporting, when it comes to other environmental objectives other than mitigation. So that includes, obviously, water, number one. Number two, we need to, and this is part of the monitoring of capital flows towards sustainable investments that we are conducting, the platform, we need to start being able to extract and start estimating how much of those investments I was talking about, those green funds, those ESG funds, green bonds, actually is going really into water, and water solutions. So that's the second one, and we're starting to work on that. The third one is that you probably realize that when it comes to the taxonomy, I talk about 110 activities versus 15. So maybe we need to boost a little bit more the water taxonomy and expand it. And one thing that is very interesting is that in the taxonomy for mitigation, for example, for renovation, you actually allow to count for individual measures. And you would say, what is that, Elena? Well, imagine is that I am a company of a marketing company, and I decide to change all my windows for triple glazing. So that investment counts as green capex for me, but also the company that installs the new windows also can count the revenues. But that allowance that it is for mitigation is not for the rest of environmental objectives. And that makes up of a lot of the investments that companies that might not have their activities included in the taxonomy can count on. So that's a priority, but then more broadly, expanded. And linked to that, to say that sort of, misregard we have for all the environmental objectives that they are not mitigation, it's also in the regulation, we see it in other tools. For example, we have climate transition benchmark, the Paris-aligned benchmark, but we don't have water transition benchmarks, right? So what does the transition mean for water? What does it mean, a transition plan, if we integrate water, and what does that benchmark? It exists because we do have ETFs in the market, so funds that replicate, passive funds that replicate benchmarks, but they are privately made. There's no sort of reference point. So we would like to work on that. And if you allow me, one last thing. And this is almost like a plead. Maybe it's like throwing a bottle, with a message into the ocean, yeah? But I believe that you're absolutely right, is the European Central Bank, the OECD, NGFS, and many others, when you say, well, the climate scenario analysis needs to be much broader. Absolutely agree. It needs to include water and nature ecosystems, yeah? Because climate scenario analysis doesn't fully reflect water risk. But the problem, the situation we have now in Europe is that, Brussels has decided to, even for climate scenario analysis, to only have to be disclosed if used. Basically, for the first time, putting Europe below the international standard, international bar. And we all know that international standards are the minimum common denominator. So one plea, and I will finish with this, to all of you, is that we still have that tiny, tiny, narrow window of influencing and changing that. Please raise your voice, because we do need climate scenario analysis. Thank you.
Couldn't agree more. Thank you for the call to action. So maybe since we heard from you exactly who can help close the gaps, maybe I'll turn to Najwa. Very briefly, in let's say 2-3 sentences, could you maybe tell me about what is most needed for emerging market supervisors that are building capacity on water from the international community? Is it technical assistance, peer exchange, data?
Yes. It's difficult to have it on three sentences, but I will give it a try. Actually, supervisors in emerging markets and developing economies are facing a double trouble, I would say, because on the one hand, we have the greater exposure, so we cannot wait. We need to have some early on actions on which nature-related risks, identification, assessment, and management. On the other, we do not have sufficient capacities. So we do rely on international community a lot, and it's thanks to the international support, especially the World Bank, EBRD, and other international partners, but also through our membership in the NGFS and all the resources that were provided and from which we have hugely benefited. We've been able to step forward in the climate-related risks management area, and so we are seeking more practical guidance on the data development methodologies for assessing and measuring the risks, because this is where the key challenges lie both for the central banks and supervisors and financial institutions. So we do rely on the international practical guidance. Events like the one we are attending today are really valuable and helpful for regulators in emerging markets and developing economies on this direction, the policy direction they need to take. But also we need to also converge toward a minimally accepted principle-based framework, set of scenarios, set of requirements, rules. It's important to have an action from the standard setting bodies. This helps also promote the consensus at the global level. It promotes cross-jurisdictional cooperation, and while paving the way for regulators and supervisors in emerging markets and developing economies to add on some of the granularity and country-specific rules. I'll stop here.
That's amazing. Thank you for being sharp on this. So given the little time that we have left, and for the sake of not overshooting too much, let's say that I'm just going to ask a broad question to both Alberto and Hannah. Two things that I think we should broach to just close and conclude this panel is, one, the supervisory expectations on water that would be most impactful for financial institutions, and also, you raised that point, Najwa, and it was raised before, where international convergence and supervisory expectations around water need to go in the near term. So both of you, maybe first Alberto, then Hannah, could you tell me on either what would one or two supervisory expectations on water would be most impactful, and how we can converge internationally?
Okay, thank you. Let me start with a clear and pragmatic message, supervisory message. Regulatory framework for water risks is already in place. So our challenge is not longer its design, but its effective operationalization. So this is the clear message that we need to share with our audience. Looking ahead, we will see two important developments in the very near term. First, the mandatory inclusion of water risk scenario within ICAP and stress testing frameworks from 2027. And second, comparable disclosure requirements under Pillar 3 by December 2026, which will significantly enhance transparency on exposure to water risks. But however, what will truly drive change over the next 12 or 18 months is not new regulation. It will be how institutions incorporate water risks into their actual decision-making processes. So from a supervisory perspective, this translates into two key expectations. First, integrate water risks into central management mechanism. So water risk should not be treated as a site analysis. It must become embedded in core management framework, and this is operationalized through three key levers. First, risk appetite framework. Second, collateral valuation. And third, water risk scenarios and ICAP. These three elements are interconnected, and better integration in risk appetite combined with improved collateral institution evaluation obviously implies a stronger credit risk models and a more robust ICAP framework. And the second expectation is integrate water risks into a strategic planning. It's about credibility in long-term planning. This will be assessed through two major supervisory chain exercises: horizontal supervisory analysis in 2026, focusing especially on physical risks, including water, and secondly, the ECB thematic review in 2027 on transition plans, which will evaluate whether water risk is genuinely embedded in banks' strategic decision making. And regarding your second question, it's just 1 minute, how to achieve a cohesion across institution and jurisdiction, avoiding a fragmented or mosaic approach. Well, it's important to recognize the some degree of diversity. It's natural and even necessary. Difference in exposure, data availability, and institutional capacity justify differentiated approaches. However, cohesion can be achieved through 4 structural pillars. First, common expectation combined with proportional implementation. Second, the SREP as a true alignment mechanism. Third, the development of a shared data infrastructure. And four, institutional coordination and supervisory networks. So let me conclude with just three messages. We do not face a lack of regulation, but a gap in consistent implementation of this kind of risk. The most expectation are those that embed water risks into core decision, risk appetite, collateral evaluation, and so on. And true cohesion will not come from uniformity, but from a combination of common standard, proportionality, a strong SREP process, and a shared data information.
Amazing. Well, it's great to know that we have concrete steps to look forward to and that you have very concrete propositions. So maybe, Hannah, you can be our nice conclusion and tell us a bit more about international convergence.
Yes. Yeah, I'll try to bridge between international convergence, mention of supervisory practices, supervisory action, but also bridge it to the reality of today, which is that a lot of supervisors, central banks, are also constrained in resources. It's not just the capacity, but also the resources. You can only have so many top priorities every year. So what we are also seeing amongst our membership is that even if maybe water or climate or nature is not the top priority in their supervisory plan this year or in their etc., actually they are already taking a lot of measures that indirectly actually also help benefit solving the issues around insurance protection gaps or issues around insurance availability and managing fiscal risk. So I'll name two examples, if I may, and then I'll close. So one is risk-based supervision. You mentioned it already. So a lot of our members, especially those in emerging markets, are moving towards risk-based supervision with, you know, I think people know what that means. So risk-based pricing, risk-based capital requirements, looking at the boards and the governance within the companies to really have a risk-based focus. Ultimately, if nature, if climate-related risks, if water-related risks are going to be indeed material or relevant for that group, it will have to be managed. And secondly, there's a lot of emphasis, again, in many different countries, but especially developing economies, on the supervisor creating what we call an enabling environment for innovation. So then it's about microinsurance, it's about parametric insurance, it's about maybe sometimes public-private partnerships, and also they're maybe originally not necessarily targeted towards water, but it was targeted towards maybe SMEs working in agriculture. Well, automatically, if you increase insurance coverage, if you work on parametric insurance and other things, then you will automatically also help coverage for either drought or flooding or other water-related risks. So I think my main message is, in the end, we all, whatever we do, even if we're not focusing on water, we are actually already doing a lot there as well in that area.
That's an amazing message to take away. Thank you, Hannah. Okay, so without further ado, I might hand it over to Maud for a few questions.
Thank you very much. It was a really interesting discussion. Thank you for having us today as well. A lot has been said, a lot of very important things. So first, obviously, water is a systemic financial risk that is closely interlinked with climate change and nature loss, making it a real system issue that we are all responsible to solve at the end. And at the same time, we are seeing a very uneven landscape across financial institutions wanting to integrate a water-related risk, with often the larger ones already quite advanced in the integration of this risk, while others are still a bit lagging, which raises also some challenges for supervisor, I guess. Second, the supervisors are clearly moving, but within constraints set by the broader regulatory architecture, but also set by specificities of nature and water-related risk. And we often risk that even if materiality is increasingly recognized, we often hear that progress still depends on research, data that are lacking, or other enabling frameworks, tools such as disclosure or taxonomy, for example. And third, what we are at an inflection point in supervisory expectation and action. But this shift will require supervisory action that are backed by forward-looking information on the risk, the impact, but also the opportunity to integrate water into financial decision-making. So I'd like to just ask you very briefly, so that a lot of financial institutions are operating globally and internationally. So it raises a certain issue when supervising them. And the first question is in the enforcement of your supervisory expectation, how you are making sure that the expectation you are issuing for banks and for insurance are being implemented. And can you also give us illustrative example of concrete action that can be done if it's not the case? The second question relates more to the tool. We are more and more talking about transition plans, and the discussion is evolving on transition plans. So, but for you, what will be the minimum thing you would like to see on, in transition plans to cover water-related risk? And the third one, which is an important one, is if we want to solve this big systemic issue, we need a bit more collaboration. How this collaboration could materialize across geographies, but also across different financial sectors, such as banks and insurance, but also asset management. Yeah, I'll leave you the liberty to answer if you are inspired.
If I may, maybe to share some concrete examples on the international perspective. In Morocco, Moroccan banks are actually also exposed to African markets. So whenever we are setting supervisory rules, they apply to both domestic and international cross-border operations. We do have some sort of collaboration which is already in place with African counterparts and supervisors. We do held each year what we call a college of supervisors, where we are gathering all the supervisors of the African region where Moroccan banks are having their subsidies, and where we also address, among other key matters, climate-related risks regulation, supervisory expectations, what needs to be done. And it's a platform of discussion where we are also informing the supervisors, on the other hand, on our rules that will be applied to their supervised entities, and in some cases, the other supervisors have already a similar expectation. So this is how we are trying to make sure that we have an alignment at the global portfolio that Moroccan banks are financing by leveraging the collaboration and cooperation process, which is already in place on supervision. So in a very near future, once we will start this risk-based approach, which is actually considered starting next year, where we may require additional capital for banks that are having excessive exposures and not implementing the necessary frameworks or processes and tools in place and not allocating sufficient capital, we would seize also these supervisors to make them informed about that, and they would do the same for the subsidies. So this will be starting very soon. Now we are conducting pilot exercises and on an informative manner for both supervised entities and the African supervisors. So this is how we are dealing with this international exposure to climate-related risks. On the other hand, maybe for the transition risks, we are having a close collaboration with our European counterparts, especially as the carbon adjustment border mechanism is in place, and it's affecting some of the exporting activities in Morocco that Moroccan banks are actually financing. So we've had the opportunity to prepare banks to this, and we have also conducted a qualitative assessment to see to what extent they would be exposed, and the good news is that they were quite prepared for that, and that the larger operators that are exposed to these mechanisms have already the necessary technical and financial capabilities. So those are two concrete examples about the international supervisory perspective, I would say. Your second question was on collaboration? No, not on collaboration. It was on collaboration, how we could collaborate internally and at the international level. I'm not going to repeat what I have said earlier, but we've seen the value of partnerships and being active in international fora for our agenda, and the international collaboration was a key driver of our successes so far. At the national level, we have touch upon the financial sector platform. We had a roadmap back in 2016, and we've also set up a strategy for developing green finance by 2030, and this was done alongside the Ministry of Finance, the financial regulators of capital markets, and insurance companies, because in Morocco the central bank is only supervised the banking sector, where we should keep in mind that the banking sector is the major part of the Moroccan financial sector, but still we are trying to have an alignment on the disclosures, on the regulations, on the supervisory expectations to make sure that the whole segments are actually having the same expectations and level of ambitions. We're also trying to seize the opportunity of this strategy because it's also considering some concrete actions from the corporate side, because in Morocco we have some sort of distortion between the corporates and the financial sector, which is quite active in managing, disclosing, but the major part of data is dependent on the corporates, and they should have the same level of engagement. So we're now working through this financial sector strategy to get everyone involved in the discussion and take the concrete actions, because we are considering concrete actions with a defined deadline for each of the key stakeholders at the national level to make sure that we are mobilizing the full capacity of financial sector towards climate action and environmental sustainability.
Thank you for those examples.
Does another one of the panelists wish to answer Maud in literally 1 minute, because I want to keep good working relationship with Noelia, who moderates the next panel.
Okay.
I can add another concrete example of, you mentioned international cooperation, maybe cooperation between insurance and banking. Yesterday and the day before, the Basel Committee met in Basel, and they always issue press releases just after that. So this is all public knowledge, but they're going to work on extreme weather events. So that's the Basel Committee on Banking Supervisors. And they will explicitly also look at the role of insurance, the extent to which banks have insurance coverage in place. And there we as the IAS and the Basel Committee are working together also to see how we can actually close this. I don't know what gap it is, but in any case, work together, talk to one another, share information as well, because we have done similar work. So this is maybe one of the first times that actually the Basel Committee and the IAS are going to do some coordination on that type of topic. So that's maybe another example of cross-sectoral coordination across financial supervisors.
Thank you.
Right, well then maybe a warm round of applause for our panelists. Thank you. And we'll let the other panel take the stage.